Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Corporate fraud is an unfortunate, costly, and seemingly never-ending aspect of the world of business. In the best case, fraud is prevented, or at least caught before harm is done. All too often, however, these cases of deception lead to large financial losses, impacting the lives of many, shareholders, individuals, and certainly those that are courageous whistleblowers. A little more than 15 years after the unwind of the Madoff Ponzi scheme, I invited Harry Markopolos back to the Alpha Exchange. Harry is often simply referred to as the man who knew. He chased Madoff for years, serving up a comprehensive slew of evidence to the SEC that was mind-boggling in its degree of logic, rigor, and scope. Our conversation looks back on the lessons of this Ponzi scheme and also zooms out to consider other examples of corporate fraud, including Theranos and FTX. Throughout our discussion, I seek to gather Harry's insights on the commonalities in these cases, how to detect them, and also, importantly, how to prevent fraud. He points to a few areas of progress on the enforcement front, but makes a strong case that the penalties associated with being caught need to be considerably larger. I hope you enjoy this episode of the Alpha Exchange, my conversation with Harry Markopolos. My guest today on the Alpha Exchange is Harry Markopolos. He is the man who knew, well known for his work in uncovering the very long-term fraud that was Bernie Madoff. Harry, it's great to reconnect and welcome to the Alpha Exchange.
It's good to be back, Dean. It's been a few years since we last did one of these podcasts. We've also done a lot of in-person meetings over the years, I should say over the decades.
When you wrote your book, No One Would Listen, I bought 30 copies. You came by the office and I had you sign every one of them.
I do remember that.
So thank you for doing that.
Speaking of fraud, my publisher, I never got paid on any of those copies.
Exactly.
The more copies I sold, the more I owed them.
Hopefully I haven't defaulted on you.
No, you haven't. I got defrauded by my publisher. They thought I was a one-and-done author, which so far I have been, but if I write another book, I'm not going to do a deal like I did the last time. I'll never take an advance. I just want a percentage.
Well, your foray into writing was not something you planned, but it turns out you're an easy-to-read writer. You had more metaphors and kind of little one-liners in that book. A serious book, but you managed to bring in quite a bit of humorous writing style. And, you know, the reason I asked you to do that was because I certainly was fascinated by your work. You and I met in 2002 in Boston. We were chatting about variant swaps and some of the math behind that. And I was one foot out the door after the meeting. It was the first time we met. And you asked me about Madoff. You said, it's a fraud. It's a Ponzi scheme. It could be that they're front-running the market-making business. And then you thought about it for all of about 10 seconds. You said, no, it's a Ponzi scheme. I'm certain of it. And that stayed with me. The conviction with which you said that stayed with me, that when I was on a train in December 2008 and on my BlackBerry, we all used BlackBerries back then, I saw the headline and your name was the first that came to my mind instantaneously. I just couldn't believe it. And then in the aftermath, we learn of all the work you did along the way, 2001, 2000, I want to say 5, 7, at least 5 times with incredible detail that you reached out to the SEC to try to flag this thing down. You were the 4th guest on the Alpha Exchange, and that was December 18. It was the 10-year anniversary of Madoff. And it's not a happy event, of course. And I know it's changed your life forever, but here we are on roughly the 15th year after it. And so I figured I'd reach back out to you and talk a little bit about Madoff and more broadly about corporate fraud. And then some of the work you're doing now on the fraud uncovering front. Again, thanks. It's awesome to talk. Let's get the conversation underway. I want to repeat back to you something you said on our first podcast in 2018. You said 45-degree angles don't exist in finance. They may exist in trigonometry or geometry, but we don't get 45-degree angles in finance. And I just love that insight. And that was up and to the right, as you said, Madoff's returns. So I'd love for you to just start there. You took a look at the returns. Walk us through your reaction and just looking at the time series of the returns.
You'd say that that couldn't exist again, but we still have cases. You'll see things like that. Did a case more recently than Madoff, and that was in 2016, Platinum Partners in New York. It was an Orthodox Jewish-led scheme out of Brooklyn and Manhattan near Carnegie Hall. And they were better than Madoff. They were at 18%. And 10 years, they only had one losing month. So they had a higher batting average than Madoff. And you say that thing can't happen again, but it does. People walk into that. Look at private credit. Some of the alphas that they're claiming in private credit, very dodgy product, I think. Too much money flowing in. What makes private credit guys think that they can underwrite risk credit better than banks? I don't think they can. And these guys are claiming Sharpe ratios, sometimes as high as 10, which is great when you're not marking your portfolio daily because it doesn't really trade in a listed market on a transparent price exchange. So we do see a lot of scams from time to time. If I had to point out one that I'd be leery of right now, it would be private credit, I would say, would be high on the risk radar for me.
And that one, if I could just jump in, it's dodgy in the sense of, and I'll just borrow from Cliff Asness here, it's a soapbox issue for him personally, which is, as you said, they're not marking to market. So you can get a pretty high Sharpe ratio if you make the denominator of vol so low. He calls it vol laundering, which is just not paying attention to actual fluctuations. It's dodgy. It's probably not fraudulent in the sense that Madoff was. And back to Madoff, you were responsible for trying to replicate this split strike conversion strategy. And maybe just touch on the impossibility of using an option strategy like that, essentially a risk reversal, and earning a 3-ish Sharpe ratio on a consistent basis.
Most obvious thing was he was using the wrong options. Why would you use the Standard & Poor's 100 OEX option, which had the American exercise? Those things get gamed all the time. He was claiming to replicate the OEX stock basket, which you wouldn't because your hedge would be the OEX, but there's no hedge on the futures. It's an imperfect hedge because the OEX, Standard & Poor's 100, is constructed vastly differently than the S&P 500, the SPX, which is where your futures layoff was. So he's just trading the wrong product, and then he was trading individual options. And why would you do that? Why would you take on single stock, company-specific risks? All they needed was one company to miss earnings or have an accounting event or some other disaster, a natural disaster like Boeing. Let's say you own Boeing shares and another one of their planes crashed. Well, how are you protected your portfolio? Boeing could drop in half. And the returns were too smooth for Madoff. He should have been using an index type strategy. Instead, he was using single stock baskets, which was poor risk management. And of course, he never was really trading options. And you could prove that by just looking at the open interest in the OEX put options. So the math never worked for Madoff. It was an obvious fraud. The only problem was all the people that were feeder funds, the hundreds of feeder funds, all those cats were saying, we've done great due diligence. And in fact, they did no due diligence. They just assumed the other guys did. And that's typically the way it goes on Wall Street. Due diligence is nothing but marketing hype. It really doesn't exist in the real world except on rare occurrences.
The due diligence aspect is interesting. I know someone who's done the work and I can free ride off of it. And I'm thinking of two other cases. Theranos, that was a really interesting one in which former US Secretary of State George Shultz was on the board, Jim Mattis, Henry Kissinger. And so it became this free riding off the reputational equity that was on the board, even though these folks didn't have any experience in medicine, they were big names. So I think that's one. And then, of course, FTX is another one where the benefit of association, whether it's with stars like Tom Brady. I don't know if you happen to see the Tom Brady roast on Netflix.
I didn't catch it yet.
It was quite funny. And they did a lot of the FTX part of things. But you get guys like Matt Damon and Tom Brady to shill for you. And then you have these other VC investors who somehow think that someone else has done the work and we can free ride off of it. That seems to be some aspect of the commonality of these things. I'm wondering if you can talk about that.
Walgreens, they put a $100 million bet on Theranos, and they never once did a proper due diligence test. And CEO lost his job for that. Well, they should have, but it's easy. You go in there with your own blood test results for the old-fashioned way, and you say, okay, I want to see your instant test results, and sign me up. Take me to the Edison machine. Let's see how it works. If anybody at Walgreens or any of the investors that got bilked had done that, this fraud wouldn't have gotten so big. And of course, nobody did it because everybody trusts, oh, it must be real. Look, it's a real company here. They have a building. They have PhDs and people with master's degrees in biosciences. Must be legit. And they didn't notice that, and wait a minute, why are there so many security guards? Oh, proprietary technology. Oh, okay. What wasn't proprietary was give me a blood test. And you could have bypassed all the bullshit and no one cut through it. And that's why so many people were fooled. And even George Shultz, God rest his soul, his own grandson told him it was a fraud and he worked there. And then they went after the grandson, Boyd Schiller, the law firm, went after him tooth and nail. So why are you sending a premier law firm after a young 20-something who actually had ethics and obviously was very smart and figured it out quickly, unlike the investment pros in Silicon Valley? And the rest is history.
If we think about Theranos, FTX, and Madoff, Madoff has the additional element of this affinity scheme, very much targeting wealthy Jewish individuals, oftentimes in the South Florida area. But perhaps all three of them have this idea that we want to believe in the quirky genius. Elizabeth Holmes took on this persona where she lowered her voice. She dressed like Steve Jobs. Everyone loved the ADD of SBF. They just thought, wow, we can't even understand how smart this guy is. And with Madoff, as of course you're more familiar than anybody, he had this unbelievable ability to create this club atmosphere that if you're getting into something that most people don't, you'd be lucky if I did allow you to get in.
It was the money club for sure. Madoff's allure. So exclusive, I don't want you in. You have to beg. And even then, I probably don't want you in because you're going to be a pain in the ass. And he just insult you as a customer, which was phenomenal on his part. Great con. As far as SBF, I'm not big into crypto, but I would say that was an affinity fraud too, because he attracted like-minded people. And they're people that are young. They grew up during the financial crisis, 2008, 2009, and they lost trust in their government as well as they should. None of the big banks were prosecuted. No one at AIG went to jail. And the Justice Department just sat on their hands. And so you can see why they would lose trust in their government and rebel. And I think that was his affinity group. As far as Madoff, he might have started in the Jewish community, but at the end, he had far more non-Jewish victims. I would say more Catholics, more Protestants. He was pretty big in Europe. I mean, he had more feeder funds, way more feeder funds in Europe than he had in the US. And he was just getting started in Asia, of course. And they would have been the newest victims if the financial crisis hadn't collapsed the Madoff scheme. But everybody starts with an affinity group of some sort. And so SBF was no different. What did he get? 25 years with good behavior. He'll probably get 85% of that. And he'll be out maybe when he turns 50 or thereabouts. That was actually a pretty good sentence for white collar. Madoff obviously got 150 years. Sir Alan Stanford, at his Ponzi scheme, what did he get? 110 years. So sometimes you get big sentences in white collar, but usually it's 2 to 7 years. So it's atypical what SBF got. Obviously, not a sympathetic person. He fit the profile of a egotistical villain, and I'm sure the judge held that against him at sentencing. And we'll see how long he lasts in prison. Looks sort of weak to me in prison. Looks like he's the type of person people would prey on.
If you look at some of these episodes of fraud, I was reviewing WorldCom goes back a ways, Enron. These things kind of lasted 3 to 7 years. Depends. The Madoff one, it's hard to date exactly when it started, but it certainly lasted a long time.
Decades.
Yeah, and it's not as if someone found it out. I mean, you did, but it's not as if someone acted on that. It was that the financial crisis hit. And so you might say, well, if the financial crisis didn't actually hit, it might have gone on for longer. What does that tell us about the length of this fraud? And, in some parts, you sort of look back on this, Harry, and you see You've documented all of this. He's got numbers in his reports printed on dot matrix paper that are just not closing prices type of thing. What does it tell us about something that could be so lengthy in duration?
It tells you that no one's really looking, that due diligence really is marketing hype. It's rare to see that in the wild, actual real due diligence, where someone camps out at your operation for maybe several days, or maybe they come back a week later and spend a couple more days, and they're just shadowing you, watching what you do. And it would be very intrusive. But if someone's going to do that, then I would say at all levels of the organization, start at the back office, go to the middle office, and then go to the top, and the people making the investment decisions. You probably have a decent idea on whether it's real. And then you'd have to take all the documentation that you've compiled, and you'd have to go to the third parties, to the custodians, to maybe the prime brokers, the trade counterparties, and verify you doing this kind of volume. And you'd have to take a look at the financial statements. And you'd have to go to the custodian and say, was the cash there on December 31st in this amount? It would take a lot of work to do real due diligence. And that's why so few people actually do it. And so few managers would even allow you to do due diligence. And so it is a leap of faith when you're doing any kind of an investment, I would say. So what have we learned from Madoff? Probably not much. Maybe we learned that we're easy to be fooled. That would be a good listen, because you had SBF. And how many people lost money with 3 arrows and the like? I remember I was pitched, Harry, if you want a mortgage, come to me. Why would you pay a bank 4% for a mortgage? I'll pay you 6% to borrow from me. And I thought, what? So I knew I was being pitched a fraud. And of course, it was a crypto scheme where these dudes, crypto bros, they thought that they could earn 18% by depositing their crypto and pay me 6%. And they thought that was an arbitrage. And I thought that was the most ridiculous thing I've ever seen. Unfortunately, I didn't know how to short crypto, or I would have. And you saw what happened in crypto. And of course, now it's back again with a vengeance. So there's schemes all over the place. And I think you mentioned one here on that write-up you sent me. I mean, Herbalife. These multi-level marketing schemes are considered cousins of the Ponzi scheme, but they're not Ponzi schemes. They're just making money, luring you into the trap so that you'll lure your friends in and have paid the company fees. In this case, it would be Herbalife. It could be anybody. It could be Amway or any of the others. Those are scams. They usually prey on different ethnic groups. Now, those are affinity schemes, but law enforcement doesn't go after them because those companies have lobbied successfully and they have exemptions to the rules, and they get away with pitching their horrible products that just suck money from poor people that can't afford to lose it.
Wanted to get your thoughts on the spectrum of fraud. You know fraud when you see it. There's obvious and absolute outright fraud. You've just described Herbalife. Obviously, in the view of Bill Ackman, Herbalife was a Ponzi scheme, and I think attached to the word Ponzi is fraud. My question is there some component of gray sometimes in the way in which businesses are set up that you might argue that one might say it's a fraud, one might say, well, this is a business construction and a marketing setup, and it's not a fraud?
Like I said, the pyramid schemes are the cousin of the Ponzi, not the Ponzi, though. The Ponzi actually will get you jail time, and the multi-level marketing scheme will make you rich, and you'll just get rich on the backs of people that are too dumb and too poor to know any better, that they think you're giving them the opportunity to succeed as an entrepreneur by building a business, when in fact they're just sucking you dry and all the victims that you lure in behind you. And when you run out of dumb people to take advantage of in the multi-level marketing schemes, it will crash. Just like when you run out of Ponzi scheme victims, when new money is overtaken by outflows, people want redemptions, that's when the Ponzi scheme is going to end. And so they're similar. Like I said, they're cousins, but they're not the same thing. One is criminal, that would be the Ponzi scheme, and one is just unethical, and that would be the multi-level marketing scam.
In some of these, not always, a Madoff is unique in the sense that it's a private fund. It's not like you could short Madoff, but there are public securities. Enron's an example where the work of Jim Chanos, forensic accounting, to really dig in and realize what they were doing, establish a short position, and frankly, hopefully profit from it. Ackman chased MBIA for years.
And he was right.
Was ultimately correct, but in the meantime, MBIA had much to say about, call it short and distort. That's what the company's going to tell you. And so I'm wondering what you think the balance there is of an investor who's got conviction, thinks they've done the work. We've got a couple out there now. Muddy Waters is an example of a private vehicle that's generally focused on shorting and tries to use the media as some mechanism for getting people woken up to what they see. I'm wondering what you think the balance there is.
When the companies say short and distort, the only market manipulation that's taken place is by the companies themselves on the accounting frauds that they're running, typically. And what do we know about Wall Street research? Dedicated short sellers like Muddy Waters, Jim Chanos, who I think retired last fall, but I believe he is managing his personal accounts still. And you have Hindenburg Research, very, very successful firm as well. And when those firms, Muddy Waters and Hindenburg, do an analytical report, companies typically say short and distort. But the companies were doing the manipulations all along, and what they were telling investors was not true. And so usually the people that are looking out for your interests are probably the short sellers, because they seem to be the truth sayers on Wall Street. The Department of Justice is fast asleep and has been since 9/11. They don't pay any attention to white-collar fraud. You haven't seen any meaningful criminal prosecutions of large companies since the days of Enron, WorldCom, Adelphia, HealthSouth, and the government's been missing in action for over 20 years. And you saw that during the global financial crisis.
When we talk about fraud, there's a couple of categories. You mentioned HealthSouth and WorldCom, Enron. A lot of that tends to be internal accounting chicanery. These systems get super complex. I was just reviewing and reading up on WorldCom from 2002, and just the amount of time it took them to really uncover that there was something there. These systems are unwieldy, trying to track all the ledgers and so forth. So it was a month's process. And of course, there's people that don't ultimately want you to know. So it's pretty easy for them to put some sand in the gears. Financial fraud can be kind of more obvious. You looked at Madoff, you saw the 45 degree. Alan Stanford, I think, was offering CDs at 13% and calling them banknotes when rates were 3% and saying they were risk-free. So those could be easier. I'm wondering on just the corporate side, you've got a great BS detector. You're willing to really dig in. What are some of the warning signs that you think immediately get you interested and say, hey, I think this is worth a look?
When you see year over year revenues go down, your profits go up, my bullshit radar gets activated. Because I know they're doing something, at least financial engineering. Maybe it's stock buybacks or purchase shares so the earnings per share continue growing. But you look at net income, you look at revenues down and down, and you got issues. And there's certain companies, when they hit a wall, are they going to be lured into, let's just do some accounting chicanery? Let's just commit accounting fraud this one quarter? Because once they get started on that path, accounting fraud is sort of like heroin addiction. Once you stick that needle in, you're not pulling it out again until you get caught and hit rock bottom. There are companies, I would say, that you look at their revenue, they could be tempted to cheat. The one that comes to mind now would be Apple. Revenues are down. Earnings per share tend to go up because why? They bought back shares. I'm not saying they're cheating. In fact, if you look at Apple's annual reports, you could do year-over comparisons for multiple years there. I would say that their annual reports are how people should write their annual reports. They're in English, and they give you the same format every year so you can do the comps. And so I'm not saying that they're cheating, but I'm saying they could be tempted to. And you take a look at their working capital. Is it negative or positive? Last year it turned negative. But their business is not doing as well as it once did. It's still doing great. It's still one of America's greatest companies. I use their products. I swear by their products. Love their financial statements. But I'm saying that even a company like that could be tempted, someone that profitable. But the other companies, when you see companies that are not Apple and their revenues aren't growing and earnings per share are going up, then I would certainly dig in. If you can't understand their financial statements because they don't make any sense, Apple's financial statements make sense. Other companies, if you look at those financial statements and you can't do year over year comparisons, you got a problem. They're hiding something. And if you want to dig in, That's probably a good thing for the short sellers to do because they seem to be the only one with the talent for diagnosing accounting frauds. And they seem to be the only ones with a forensic accounting ability. And so you listen to those people because they're pretty smart.
I was just, again, going through WorldCom. This woman was named Cynthia Cooper, Sharon Watkins on Enron. It's a tough slog. And I'm sure what you went through was extremely difficult for years. I'm just wondering if you could take us through the aftermath. You became quite a prominent figure in 2009 and beyond. And maybe just walk us through a little bit of that experience, but also what broadly has occurred in terms of what it means to be a whistleblower or someone who's trying to detect fraud. Is that viewed differently post Madoff? What's changed?
The Madoff case, my testimony before Congress, led us to the whistleblower program. I advocated that we needed a program. And I handed out statistics from the Association of Certified Fraud Examiners that showed that whistleblowers were 23 times more effective than law enforcement. Whistleblowers caught 46% of the fraud, law enforcement 2%. Congress agreed. We had a whistleblower program for the CFTC and the SEC. Now, if you look at the government, other agencies are starting whistleblower programs, including FinCEN for money laundering. The IRS has a program, but it's been pretty much ineffective because the IRS hates whistleblowers and they lack the investigative resources to actually know tax fraud when they see it. The only fraudsters they go after the poor and the minorities. For low dollar amount frauds, typically earned income tax credit, payroll protection fraud. Their IT is pretty poor. In fact, it's beyond poor. It's decades out of date. And so they can't do the large cases against the billionaires and the companies that are cheating. So they do a lot of small cases and pad their statistics on the backs of the weak and the poor and the minorities. So it just depends. It's a mixed bag out there on whistleblowers. I'd say the SEC program and the CFTC program, people come in with complex large dollar frauds and the SEC punishes, but it's pennies on a dollar. You haven't seen meaningful white collar prosecutions on Wall Street since the days of WorldCom, Enron, Health South, and Adelphia. And that was during President George Bush, his first term. And it hasn't been anything for 2 decades. Right now, I'd say it's a very dangerous time for investors.
Is the regime of regulation related to a bull market or a bear market?
Yeah, I would say it is. In a bull market, they don't do anything. Things are great. Why should we worry about prosecutions? In a bear market, oh my God, things are terrible. We can't afford to go after these banks. People would lose confidence in them. There could be bank runs. It could cause a systemic collapse of these firms. Well, I would argue the opposite. You've just created moral hazard by not prosecuting.
You've made the comment in some of your public testimony that you looked at Madoff and you very easily saw this is not possible. No one's running a 3 Sharpe ratio for 10 plus years. I think the fund barely lost money in August 1998 when LTCM went down. And then you ask some basic questions. Who are his listed option counterparties, et cetera? Where's the volume? But then you also had to do some math as part of your request to replicate this strategy. And you know a ton about options. And so I'm wondering, just on the enforcement side, this came up in your testimony that these folks are not even that they're not empowered, that they're not equipped with the skill set to understand a lot of this complex stuff. How do you rectify that?
The SEC took my advice and the testimony. They went out and got financial experts to join the SEC. As you know, when you get laid off on Wall Street in your 50s or 60s, it's hard to get another job. So the SEC offered employment to those folks. And so they have subject matter experts that they can make use of now. They may not have them in every office, but they exist somewhere, typically within the SEC's ranks. And thanks to the audiovisual capabilities of Zoom and WebEx and Microsoft Teams, those people can participate in analyzing cases. And I would say that if you have someone with industry experience, they can understand a fraud and hopefully simplify the explanation so that even the SEC's attorneys and federal prosecutors can understand that. And you have to be able to do that because your typical lawyers are not finance people. They're not accounting people. They majored in something else and then went into the law. And so if you're a financial expert, you have to simplify things so that lay people like lawyers can understand your case, because if the government's attorneys can't understand your case, then a jury is not going to, and the case will never get brought to trial. And so The SEC has done a lot to reform itself in the wake of Madoff, but they still have a long ways to go. I would say they still avoid the big cases, and their punishments are no touch, light touch fines that encourage more fraud. They don't deter fraud.
The Madoff case you're certainly most known for, but you've been involved and uncovered some other important cases, one of which is a currency manipulation case. Talk to us about that. Just kind of lay that out for us. I don't think a lot of people know nearly as much about that one, but it's certainly interesting.
The custody banksters, they're promising to be honest fiduciaries. They're promising you, the mutual fund, the hedge fund, pension funds, we're going to give you straight through, real-time processing, best price execution. We're a fiduciary. They had big contracts, dozens to hundreds of pages long. And they made all these representations and warranties that were worthless, not worth the paper they were printed on. So no one checked because the contracts had all the right stuff. Best price execution, real time. And if they had looked at their price bills on currencies, what they would have noticed is they got the worst prices. If you were buying, you got the highest price of the day. And sometimes you got the higher than the highs. And if you were selling a currency, you got the lows. And sometimes you got lower than the lows. No one checked. This went on for decades. You got the same bad price bills to 4 decimal places that every other sucker got. And no one checked. So you had thousands of people working at the custody banks, at the mutual funds, the pension funds, hedge funds. No one noticed that their fills sucked. What can I say? You just have to look. If you look, if you turn over enough rocks, you're going to see snakes. That was an easy case. It took years to get the government to pay attention to it and to punish it. And the fines were minuscule.
The slap on the wrist is a common refrain post someone paying a fine of some kind. I think you do make a good point that deterrence is about the severity of the outcome for being caught. I think that's at least part of the recipe. Of course, very effective oversight is another part of deterrence, not enabling it to even occur in the first place, but consequences matter. That's important. So tell me, what animates you these days? What are you up to? I'd love to just learn a little bit more about the kind of evolution of how you think about these over time. You talk sometimes about, I think it's the ACFE, which I've just learned it was started in 1988. I didn't know it was that old, but I'd just be curious. It's a very unique skill set. It's a very unique undertaking. You got to have a real strong nose for BS. It's an interesting type of person that's going to be drawn towards doing the work that you're doing. And I just love for you to reflect on your years of doing it at this point.
I'd say that you got to go somewhere for training. The ACFE is a good source for that training, but then you have to go beyond it. You got to really self-train in this field, and it really helps to have industry experience. I'll give you an example. A buddy of mine, Chris Piacentilli, he was in sales in the durable medical device equipment market for hospitals and large physician practices for a long time. And now he does healthcare fraud cases. And he's probably the world's best healthcare investigator. And here's a guy that he reads every case. He reads every pronouncement that the Center for Medicare puts out. He looks at the budget for Medicare and what they're spending by category. And when he sees growth in certain categories, I mean, he just knows how to diagnose frauds. He's brilliant. But you don't become brilliant overnight. You become brilliant over a period of decades. And it's a cumulative process as you train yourself up. You're always reading things. I would say that I'm doing that in finance. And if you wanted to be good in green energy fraud, you'd probably do the same in green energy. And you'd read all the cases of fraud out there. There's a growing body of cases in green energy. I don't pretend to be an expert at it, but somebody should be. There's always new areas of fraud that you can train yourself in, and you can make a living with the proper whistleblower programs. And you can stop some fraud. Unfortunately, what's missing is the criminal enforcement and tough enforcement by the regulators.
Back when you were chasing Madoff, there was nothing called artificial intelligence or machine learning. And now we can train these models on corporate transcripts. And what's got me asking this question is something you alluded to before, which is the way in which things are presented. Apple makes it easy. If you see something changing over time, searching for these things has gotten much easier. I was talking to an investment contact around looking for potential inconsistencies in corporate statements. And they find that even grammatical errors, which might seem innocent, tend to be associated with some alpha in predicting volatility. You try to do something quickly, it's haphazard, and there is some coincidence with whether it's carelessness or just not being as exacting as you ought to be, that's reflected in a corporate statement with grammatical errors. Now, we couldn't do that 20 years ago. So my question is around these new data techniques. Do those make your way into your process at all?
Yes. What I worry about AI is you're going to have RI, real intelligence. And so I get asked by the fintechsters all the time, give us something for AI. And I'm not going to make the bad guys harder to catch. So I'm not going to help them. And the reason is there's no market for detecting fraud in the corporate world. The playing field favors committing fraud. By and by, I don't know that there's a paying market for AI fraud detection. I fear that it's the other way around, AI being used to commit fraud. I'm not seeing it as a boon to the fraud professionals that are trying to combat fraud. I have a feeling it's going to be more of an opponent than an assist for us. I'm not saying we can't use it. I'm just saying that we'll see where it goes. But I have a feeling the propensity is going to be to commit more evil and not to stop evil.
As we close out, as we talked about at the top of the call, you and I met in Boston talking about equity derivatives. We share that as part of our lineage. Are you actively looking at markets these days, looking at financial product innovation or anything like that?
I don't keep my hand in as much as I once did. For instance, I'm not reading the streets derivatives research. If I see new math, I sort of like it. But in derivatives, well, Dean, you've been there. Most of the products are there to deceive you as an investor. They'll show you the good stuff. But if you can't do the math for those products, you really shouldn't be buying them. Because there's always things hidden in there in those formulas to trip up people that don't know the math. And so you need to know for structured products, Dean, what percentage of those are good for investors? Come on. Let me put you on the spot for a second here.
Well, there's an old saying that structured products are sold, not bought, which I always thought really captured, hey, we can find something that optically looks better than it really economically is. That's the goal.
It is, and they hidden fees and deck stacked against you. If you own a structured product, you end up getting sold into one of those horrible products, your chances of winning are very slim. If you win, well, it wasn't designed for you to win. You just got lucky. You drew a royal straight flush at the poker table if you win on a structured product. So you always have to be on guard when it comes to your investments. And I can see that's why a lot of people go to the index funds.
There are occasions where some version of bells and whistles on a product can be helpful, but you really are evaluating that versus the trade-off of liquidity. You just don't want to be selling vol well below market or buying it well above market. And that's unfortunately some of these products in their complexity is hiding that ultimate transaction, which is away from the fair value, even though it doesn't look like it. So you definitely have to be careful. And at least over time, for me, I've really tried to emphasize liquidity. It's not just getting into the trade, but you never can decide to hold a product to maturity. That might happen, but you don't want to pre-commit to it. The unwind price is critical. Getting liquidity on the unwind is really important. So you got to have the exit plan, not just the entrance plan.
I like the liquidity like you do. If I can find some way to replicate something in the listed markets and avoid the private markets where I have to wait for tax forms, I prefer the liquid alternatives.
Keep it simple. That seems to be the Harry MO.
Why do something really crazy like private equity? Or you can replicate that stuff a lot cheaper with some combination of index funds. You just may have to go into the Russell 2000 or something, but you should be able to replicate it a lot cheaper, less fees, very similar returns. Look at where those products are right now when the windows are closed for IPOs. You're sort of sucking buttermilk. They're not returning cash to the investors now.
Well, Harry, it's been awesome to catch up after these years. Appreciate the insights. It was, I don't want to use the word fun to look back on Madoff because it's never fun, but I always do find it to be instructive and worth doing as an exercise because they're painful lessons, but they're important lessons as well. And you were a huge part of teaching those lessons and trying your very best to alert folks as to what was going on. Thank you for spending the time. It was great to catch up with you again.
Thank you, Dean. Take care. Be well. Look forward to seeing you hopefully near Westchester one of these days.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.